Now friends, let me quickly revise your international taxation and key and the most important highlights step by step. Okay. The first thing friends which I want to revise quickly is the concept of P2P and P2A. See, under section 9 we said that any income out of the business connection will be taxable in India. That particular business connection is basically kind of a transaction which is between P2A, that means principal to agent transaction. Now just imagine a simple situation where, say for example, there is an importer and exporter. So for example, if I'm importing some goods into India, okay, and there is one foreign exporter from whom I'm already buying it. So when I'm doing a transaction with a foreign person, and when that particular goods are imported and thereafter I sell it into the domestic market. So when I sell that particular goods into the domestic market, it is actually sold in India. So naturally the Indian income will of course be chargeable to tax in India. There is no doubt about that. However, what about the transaction which I have done with that foreign seller? Whether the income of the foreign seller, which is actually the income of the foreign country, will that ever be chargeable to tax in India? Now that particular point always comes into picture with respect to P2P and P2A. Basically we call it the concept of business connection. Now see, you understand this very carefully. Now say for example, there is a gentleman, say for example Mr. N. Okay, this Mr. N is basically a foreign seller and I am an importer, Mr. I. Okay, so there is a transaction between I and N. I is an Indian person. That way I just symbolically say. So I am importing from a foreign person, and my relationship with the foreign person is a P2P. It's just like he's a seller and I am a buyer. So it's a seller sell and the buyer buy. So it's an independent relationship. In that particular case, whatever is the profits of the foreign company, that means a foreign person, okay, it will not be taxable in India. In other words, it's just like a foreign person sold the goods in the foreign country. That's all. So a foreign person sold goods in the foreign country, no doubt you have imported into India. You don't expect Indian government to collect tax on that particular transaction because a foreign person has sold the goods in the foreign country. As simple as that. However, if I as Mr. I, if I act as an agent of that particular person, so say for example there is a foreign company and foreign company wants to boost its sales into the Indian market. So what it will do, it will appoint one agent and through the agent it will carry out the transaction. So again Mr. I will import the goods from that particular foreign person, but the relationship of this between Mr. I and Mr. N, that means a foreign person in my example, is that of an agent principal relationship. So basically that Mr. I is now working as an agent of that particular person. So it means that the foreign person through the agent is selling the goods into Indian market. Now if these goods are sold into the Indian market, no doubt that the Indian profits will of course be taxable in India. So this is the Indian profit. So whatever is the import price and the local domestic sale price, the differences are of course the income chargeable to tax in India. But even the profits of the foreign person, okay, which we normally call as a foreign income, that will also become taxable in India because this Mr. I is the agent of that particular person. And there comes the concept of a business connection. So business, the behind of this particular concept is the business connection. So if there is a business connection, it is the foreign income of the foreign person will also become taxable in India if there is a business connection. However, there is no doubt that the Indian incomes are always taxable in India. That means anybody, whether principal importing or agent importing, after importing whatever you sell in India, the Indian sale price and that particular relevant cost, the difference will always be Indian income. Indian income will always be taxable in India, no matter whether you are principal or whether you are an agent. However, the relationship principal and agent, that is very important and very significant in order to decide whether the foreign income of the foreign person will be taxable in India or not. That is the key point here. Okay, so if I want to just simply conclude in the simple words, if there is a principal to agent relationship, if it is a principal to agent relationship, then the foreign income is always taxable in India. However, if it is not an agent, that means it is a P2P kind of relationship, then the foreign incomes does not become taxable in India. Is a hardcore concept of this particular business connection, section 9. Okay, now friends, these are few type of questions which is also related to section 9 and section 115A. Now, first of all, friends, these kind of questions which I just quickly brushing it up for you, reason being that this type of questions are very important and they are repeated in the variety of the examinations across the institutes. So it is not just our CA institute, but even CS institute, ICW institute, whenever they have the opportunities, they ask this type of questions to the students. Okay. Now see, first of all, I'm just telling you one simple conclusion. Section 9, read with section 105A. If there is any royalty technical fees transaction, there is a special rate of tax which is at the rate of 10%. Okay, so any royalty technical fees, of course 115A has its own condition. If that particular basic condition is satisfied section 115A, then royalty technical fees, read with section 9, if it is deemed to occur or arise in India, it will be taxable at special rates of tax in India, which is at the rate of 10%. And that particular point oftenly in different way comes into picture. The first thing is, what is a royalty technical fees? Now, these royalty technical fees is in detail defined under section 9. So, some part of these type of questions is going to test your knowledge whether the transactions are royalty technical fees or not. Okay, because see, royalty is not just always just the plain word which is royalty. Even if it is something which is in relation to the industrial knowledge, it is also regarded as a royalty by the definition, and therefore it will come under this particular ambit of section 9 reduced to 115A and will be coming into a special tax rate category of 10%. So see, look at this particular question type. Now in this particular question, it's just a type of question. I mean, I don't know to solve the question. Okay. So in this particular case, there is some industrial equipment which has been leased at some payment. So it is a leasing of an industrial equipment. So you may feel, friends, that this is a kind of a rent transaction. It is not a royalty. So if you take this kind of view in exam, you will go wrong, because the lease of an industrial equipment is also, as per the definition, a royalty. So one of the things that, friends, what is royalty? What is technical fees? Go through that particular definition very precisely, and that I already given it to you under section 9. So this will also be take a royalty transaction. Now if you see, this was one of the very popular question like Bharat Mines, and Bharat Mines has entered into some agreement with British Mines and all that. Now if you see, there is some consideration, and this particular consideration is broken up into drawings, design, engineering services, and salary and the other allowances paid to the staff deputed abroad. Okay, deputed for the work in India. Now this particular one of the main dot will come with the drawings and designs. Okay, will the drawings and designs, whatever the payment that you are making for this preparation of drawings, designs and all that, is it a royalty technical fees? So it is still a royalty technical fees by the definition. Engineering services also royalty technical fees. And now the dot will come into this particular third type, salary. So you will feel, how can the salary be regarded as a royalty technical fees? But it has always been said, it is a part and parcel of one agreement, and this whole agreement is a royalty technical fees agreement, and therefore the name which is given to the transaction is so called as salary for this particular work of their employees in India, but the whole agreement will be of the royalty technical fees. So it will have the special rates of tax and the special tax calculations in this particular situation. So once again, the type of questions which you should know it very properly is this a royalty technical fees kind of a transaction? That is one of the point. Okay, now friends, there is another type of a question. Okay, now this type question and this type question, first of all, you see this the last question. Okay, in this particular situation there are two agreements. Okay, so say for example, industrial equipments. Now this particular industrial equipments, there can be a situation where there is a sale of industrial equipments. That is one part of the agreement. Another is its installation and the other services which are linked with that particular equipment. So say for example, there is a foreign seller of some industrial equipment, and you as an Indian importer has entered into agreement, but your agreement is divided into two parts, or maybe say there are two separate agreements. Okay, so normally the sale of equipments is not a royalty technical fees, but the services which are relating to the installation, commissioning and other services in relation to this particular industrial equipment can be regarded as royalty technical fees. So the courts have always stated very precisely, if there are two separate agreements, I repeat, there are two separate agreements you can clearly identify, then the sale of equipments is not a royalty technical fees. It is not a royalty because it's a sale of an asset. So sale of an asset, or maybe sale of goods, because that particular company, the foreign company, maybe they are the dealer of these industrial goods, maybe. So the sale of an equipment cannot be regarded as a royalty technical fees. However, if there is any other services which are linked with the all these equipments, can be regarded as a royalty technical fees. Okay, so this is one of the situation. Okay, so this is one type of question. I'm just taking up that particular type of questions, and this royalty technical fees questions, friends, it is very, very important, and oftenly it will get tested in the examination condition. Now see, in this particular situation, this particular one company, they have entered into an agreement into two parts. Okay, so what is the difference here? In the last question, it is two agreement, that two separate agreement, and here it is two parts. The agreement is only one, but there are two parts. But again, the concept remains the same, that if you can clearly identify that what is for the sale of the equipments, or what is for the sale of the assets, what is for the sale of the goods, etc., the sale transaction is not a royalty technical fees, and whatever are the associated services with the industrial equipments can be regarded as a royalty technical fees. This is one of the concept that you got to remember. The next point, friends, that you need to remember very precisely, that there are three most important valuable sections where there is a key difference between tax liability calculation of resident and non-resident. Okay, now however, I have also got some summary with respect to, I think it will already come, or maybe in my regular class I will take care, that what are the key differences for tax liability calculation between a resident and non-resident. Okay, now see, supposing if you're a resident person, listen very carefully, the basic exemption for the specified transaction, or for the specified incomes, okay, you can take that particular basic exemption. Okay, however, if you are a non-resident person, then you cannot use the basic exemption for the specified transaction. This is one of the very, very key difference in this particular situation, and this key difference only I want to bring as a matter of example. Let us assume that as a matter of example, you have long-term capital gains of only 10,000 rupees. Only, you have no other income. If you are a resident person, then your tax liability will be nil, because 10,000 will be used against basic exemption limit. However, the non-resident cannot use basic exemption for these specified incomes of 112, 112A and 111A kind of an income. So the tax liability will be the appropriate tax liability of the respective section. But I am saying that 10,000 is taxable. So LTCT tax rate is 20%. So it is 20%. I mean, for the sake of simplicity. So the one of the key differences is that the basic exemption for the specified incomes can be taken by the resident person, but a non-resident person cannot take that particular advantage. So for the specified incomes, you will have to multiply specified rates of tax, and accordingly the tax liability has to be calculated. Okay, now accordingly, friends, this kind of differences that you should already know in a special rate chapter. Now friends, in the special rate chapter, friends, in many of these particular special rate chapters, there are a couple of differences between resident, because some of the sections are only for the non-resident persons. So that particular differences that you should know, particularly in relation to the special rate chapter. One of these was one of the very key important points, so I thought that I should take it up for the purpose of revision. Okay, now the next type of a question is, this is also one of the very popular type of the question. First of all, this is a question based on royalty technical fees and some specified interest income, and for that you have specified income multiplied by the specified rate and get the tax liability, surcharge and cess on merits and get the amount of the total tax liability. So here the message with respect to the tax liability calculation is the specified income, specified rate, and surcharge and cess on merit, and accordingly you have to calculate the tax liability. But if you see here, this particular is again a very, very famous type of a question, and this type of question has oftenly got repeated, friends, in the examination condition. Just look at this. Now this particular company is basically a non-resident company. It has entered into a collaboration agreement. So this collaboration agreement basically is a transaction of a royalty technical fees. That is one of the point which is very, very careful. Okay, now it has made different payments. Okay, it has received this particular payments. How to deal with them in terms of the computation? Okay, now actually the royalty technical fees, the payment here which was already made, it was paid in form of debentures, okay, and service charges. Okay, so this is some service charges for the plant and machinery whose value was this particular figure. So basically interest on debentures. Actually this particular debenture has been issued as a part of the consideration. So whatever has been the debenture which has already been issued as a part of the consideration, that means this 50 lakhs rupees is actually not the payment, but it is basically the money paid in form of a issue of debentures. Okay, so that is also covered by this. ultimately it's in nature of royalty technical fees. That's all what this particular question is trying to test your knowledge. So the payment of royalty technical fees could also be made by means of issue of debentures, and on these debentures you will have some interest income also. So interest income will also come into this particular category, and accordingly the tax liability has to be calculated. And this is the, what should I say, a very famous type of examination question, where oftenly this type of question has got repeated in the examination condition. Okay, so net tax liability computation, no big deal whatsoever. Okay, now this particular question is also another very popular examination type question, which is based on the representative assessee, where it is principal agent relationship. Okay, now this particular question is basically based on some Supreme Court judgment, where it was one Indian advocate or Indian what should I say, a firm of solicitors who has taken the services of some foreign firm of solicitor, basically principal to agent relationship transaction with respect to the service sector. So Indian firm solicitors had taken some services of not taken the services, but they have associated with some foreign solicitor to fight some case in India. And the court has held that when a foreign solicitor has fought a case, that means earned some income in India with the help of Indian solicitors, that means without their help this kind of services been rendered to their client was not possible, it will create a principal agent relationship. Okay, and Indian solicitor, that means Indian service provider, will be regarded as an agent of the foreign person, and accordingly will be responsible for the purpose of tax liability, the tax treatment in India. Now this is so famous question, friends, that so many times repeated in the exam also, and but they repeated with some different words and different kinds. So this kind of question, of course, in detail I already discussed in my regular class. It should be revised very properly by you, so that you know that even for the service sector, how the principal agent relationship etc. has already been established. I once again repeat, where a foreign solicitor firm takes a help or associates directly and indirectly with Indian solicitor firm to provide their services in India, okay, then the relationship between Indian solicitor firm and the foreign solicitor firm is similar to a business connection. Okay, and since it is a business connection, like principal agent kind of a relationship, not exactly the agent, but it is something like a business connection, and therefore it will be liable to taxation in India. The Indian solicitor firm will be responsible to the government as an agent of the foreign person, called as the agent of the non-resident. And accordingly, these kind of questions oftenly got repeated in the examination condition. Now friends, let me quickly revise your special rates of taxes. Now in the special rates of taxes, friends, there is one general theme, and general theme that you have to understand is that unless and until it is specifically provided, specified income multiplied by the specified rate. I repeat, specified income multiplied by specified rate. That means do not give any basic exemption with respect to the specified income unless and until it is otherwise specified. This is a very general thing that I am already telling you. Okay, and the rate you will have to remember, and the type of income that you will have to remember, then have to just multiply and do the tax liability. This special rate chapter in international taxation is, friends, all about tax liability calculation, and together with that some of the other clarifications will be there. That is a main theme in this particular chapter. Okay, now I'll just take up this particular few examples step by step. Section 115 BBA, non-resident non-citizen sports person. So there is a special rate which is already provided. So specified income multiply with the specified rate and get the amount of the tax liability. However, if the same person has got some other specified incomes, then with that specified income you will multiply the specified rate of that income and multiply that and get the tax liability, and accordingly apply the surcharge in the cess on merits and get the amount of the tax liability. Now friends, under section 115 BBA there is one very special provision, and this provision is there in very few places. 115 BBA is one of them. This 115 BBA, supposing if this income was the only income of the assessee, supposing if this income was the only income of that particular non-resident non-citizen sports person, then and of course the tax on that already been deducted, then he need not even file the return of income. So basically there is a procedural relaxation also given by the law, that for this particular income you might not have to file a return of income if this was the only income, and the tax required to be deducted on that have already been deducted. Okay, so that kind of situation will come into picture. Okay, now whenever there is any payments which is required to non-resident or a foreign company, it is always subjected to the TDS provisions also. So you already know that. But remember that any TDS to non-resident or to the foreign company, the TDS has to be increased by the appropriate amount of the surcharge and the appropriate amount of the cess. However, if there is any payment made to the resident person, then the rate of TDS is not to be increased by the amount of the surcharge and the cess. So this is one of the key difference from the TDS for the non-resident and the foreign company point of view. So if you take up this particular example, now supposing if this particular 115 BBA income, okay, supposing if it was 5 lakhs rupees income, so on that you deduct the applicable amount of the TDS and on that applicable surcharge and the cess. Now this particular surcharge is not included because this 5 lakh rupees is not crossing the limit for the purpose of surcharge. If it would have crossed, then appropriate amount of the surcharge should have also been included for the purpose of TDS purposes. So this 5 lakhs minus the total TDS and net figure have to be deducted, and balance figure has to be paid to the respective person. Now sometimes some of the question will tell you that supposing the payment which is made to that particular person, the net figure is X amount. So say for example net figure is 5 lakhs of rupees. So some questions may tell you that the payment is 5 lakhs of rupees and from that you have to deduct the tax at source. Or some question may say that you have to make the payment of 5 lakhs of rupees. That is basically the after TDS figure by itself should be 5 lakhs of rupees. So what you have to do in such a question, you have to just gross it up. So what you have to do is that supposing if this 5 lakhs of rupees was this 79.20%, then how much would have been 20%? How much would have been 100%? So that cross multiplication you will just have to do that and get the amount of the gross amount of the income. In other words, such kind of tricks will be played in the examination condition. Now friends, this was one of the situation where there was a foreign company, and this particular foreign company in the given question is not given to us whether it is a resident or a non-resident. So we go with the view that this was a foreign company and non-resident, and this particular company had a permanent establishment, then had a branch office in India, therefore it had a permanent establishment in India. Now moment friends, you know this much of fact, it is a foreign company, okay, and it has a branch in India. First of all, foreign company means you have to, unless it is given that it was resident in India, it is better that we follow the view that it was non-resident. And the moment you say that there was a branch in India, it means that section 115A provisions will not apply, because this will be a situation covered by section 44DA. Okay, in other words, if you have a permanent establishment in India, then the special rate of tax of section 115A do not apply in this particular situation. Okay, now friends, in the given case, this particular company had rate. So the normal foreign company's tax rate, that is 40%, that particular tax rate will be applicable to its normal income. Okay, now this particular company had some technical fees etc. provisions, but because you are covered by 44DA provision, the normal rate of tax will apply. The special rate of tax of 115A provision will not apply. Why? Because this particular company had a branch in India. That was one of the basis of this kind of a computation. Okay, and therefore this income, although it is a technical fees, you may feel that it is covered by section 115A, but that particular special rate of tax will not be applicable in this particular situation. So I have already taken multiply with the 40%. Okay, now 115 BBDA provision, here sometimes some people debate on this particular front, but 115 BBDA provision applies to a specified assessee who is a resident in India. And once you are a non-resident in India, a company is a non-resident in India, then 115 BBDA provision do not apply. That means whatever is the amount of the dividend. So even if the dividend is 12 lakhs of rupees, which is more than 10 lakhs of rupees, that is the limit of 115 BBDA provision, still it will not be taxable. It will not be taxable under 115 BBDA provision. Okay, reason being that this given assessee is a non-resident person, and because the 115 BBDA provision is applicable only to the specified resident assessee. Okay, now the next thing is that this particular company had some interest income, which was a specified interest income covered by section 115, a special rate of tax. So to that extent I can multiply special rate of tax. 115 BBF, the royalty from patent. Now royalty from patent, basically friends, it's applicable only in relation to the resident assessee. Okay, but this particular answer that we are giving, this particular fact that we are discussing, is keeping in mind that the assessee is a non-resident, and that's the reason 115 BBF provision also we will not apply, and that's the reason for this kind of royalty from patents we are going to multiply with a normal rate of tax, and that is 40%. Okay, because that is with respect to this particular foreign company. Now on that we will multiply the applicable amount of the surcharge and applicable amount of the cess and get the amount of the tax liability. Now friends, here sometimes some people take a different view with respect to the 115 BBDA applicability, because it is a specified assessee resident in India, and specified assessee has already been defined here. The specified assessee does not include domestic companies, some of the charitable institutions and the charitable trust. So these people are again not covered by section 115 BBDA provision. So for example, if the trust has got some very huge amount of the dividend income, then also 115 BBDA provisions will not be applicable. So the people sometimes get confused and saying that the specified assessee, that means a domestic company is not a specified assessee, so foreign company is a specified assessee. That kind of a situation it can come. So you can say, can a foreign company be covered by 115 BBDA? You might say that yes, no, you will have a double mind, but it depends on the residential status. The foreign company can be resident also, foreign company can be non-resident also. Okay, so if the foreign company is a resident, then the 115 BBDA provision could apply. However, if the foreign company is non-resident, then we will say that 115 BBDA provision is not applicable. And this given fact that we have already discussed is considering the non-resident and the foreign company, and that's the reason we have taken the view saying that 115 BBDA provision with respect to the dividend income does not apply. Next example. Okay, friends, in this particular example, see, one of the point to be noted here is that again, this is same to same repeated example with respect to some other specified types of income. So any dividend from the foreign subsidiary, there is a special rate. So dividend from foreign subsidiary will be multiplied with the special rate of tax. Long-term capital gains referred to under section 112A. Now under 112A there is a basic limit. So to that extent nothing will be taxable. Only where your income exceeds, then the excess figure above the basic limit of 112A will be chargeable to tax. And accordingly the tax liability surcharge will have to be calculated on merits depending on the situation, whatever that you already have it. Okay, so basically the message here is that specified income multiplied by the specified rates of tax, and the list of this specified income and specified rate already given it to you in our regular class, that you have to remember. Now friends, in this particular situation, this particular assessee is an individual. Now this particular individual has got 222E dividend income. So 222E dividend income, one of the point which I want to make it very clear that normally 115 BBDA provision is applicable if your income dividend income in aggregate exceeds the specified limit, that is 115 BBDA provision. However, 115 BBDA provision do not apply to 222E. So 222E income is, say for example 25 lakhs of rupees, but still the 115 BBDA provision will not be applicable, because 115 BBDA provision do not apply to 222E dividend type. Other dividend type, that is 222 ABCD, if that particular dividend type would have crossed the limit of 115 BBDA, then such amount will have to be subjected to the taxation for that particular assessee type. The message here is that 115 BBDA income, that is your aggregate dividend, that particular dividend does not include 222E dividend for that. That means 222E dividend any amount, because on that dividend tax is already there and company will have to pay dividend tax. So the entire amount will be taken as exempt in the hands of the shareholder. Okay, now this is another computation of, these are all computation example of another individual person. Now this particular person has got some of the incomes of section 69 ABCD. Okay, now unexplained cash credits, bogus loan, unexplained expenditure, these are all series of section 68, 69, 69 ABCD etc. provision. These particular provisions, friends, if there is any income of that particular section, then there is a special rate of tax, that is 60%. Remember this very, very carefully. A very, very special rate of tax, that is 60%. Okay, and not only that, on this particular income tax, that means 60%, on that there is a very special surcharge. I repeat, there is a very special surcharge of 25%. Okay, now some people, some textbooks will practically we say that tax on this 68, 69 etc. income is 75%. That was there, because 60% is the tax rate and 25% surcharge of that will end up with 75%. So that way mathematically it can be said. So that way mathematically there is nothing wrong. But in the examination condition, you better show 60% tax separately and better show the surcharge, a special surcharge on that particular tax separately for this particular purpose and this particular calculation. Now friends, there is one special penalty provision also which is linked with this particular provision. Okay. Now if this particular amount of section 68, 69, if it is declared by the assessee himself in the return of income. So supposing if I myself declare that this was a bogus loan and I myself offer it to tax for 60%, Okay, and I pay tax, of course 25% surcharge also. I myself pay it. Okay, I declare it and I pay it. In that particular situation, the penalty will not be applicable in that particular situation. Okay, however, if it is not disclosed by the assessee in the return as per section 271 ASC, and the assessing officer go and catch up that particular figure, okay, and in that particular case the penalty, which will be 10%, that will be applicable on this particular tax liability. So in other words, if you yourself go and declare, and if you yourself commit, okay, that this was my bogus loan and all that, and I pay the tax accordingly, I pay the surcharge accordingly, so government says you will be saved from the penalty, and otherwise the penalty will be 10% on that particular figure if the assessing officer go and catch you on this particular front. Okay, now friends, let me just quickly revise chapter 12a. Chapter 12a is for non-resident Indians. I repeat, chapter 12a is for non-resident Indians. Before I go with this particular chapter, friends, let me tell you that this is very important chapter, and different variety of questions that we have, hardly 2-3 different varieties of questions that we have in this particular chapter. But oftenly it will get repeated and repeated in the examination condition, because students will normally fail to answer the questions in this particular chapter very precisely in the examination condition. However, the chapter is very simple, provided that your fundamental concept is very clear. However, this is the revision class, and therefore I will not be able to explain to you everything into the detail, but the key highlights that I would like to give it to you in a very shortest possible time. Okay, first of all, friends, as per chapter 12a, which is applicable to the non-resident Indian, this particular chapter is a optional chapter to the non-resident Indians, and this is a key beauty of this particular chapter. So if the non-resident Indian wish to elect not to be governed by the provisions of this particular chapter, he can do so. That means if he wants that, if you don't want to apply the special rates chapter, which is of course a beneficial chapter, but still if he thinks that he don't want to apply, then he can do that. And one of the very basic example I will tell you, that why will a non-resident Indian not like to use this particular chapter sometimes. And very damn simple example that I will give it to you. There is something called as a investment income. Okay, the investment income is basically like your interest dividend type income. Dividend is anyway exempt under section 1150. So specified interest income, basically interest on debentures of a public limited company, or interest on specified securities of the central, state government, etc. Of the government. These particular investment income, friends, say for example the amount is rupees 1 lakh. Okay, now non-resident Indian governed by this particular chapter will have to pay a special rate of tax. There is a special rate of tax of 20%. Okay, so you'll have to pay 20,000 rupees. But when you are governed by this particular chapter, you don't get a basic exemption limit. Okay, so he will say, the non-resident Indian will say that I have only 1 lakh of rupees, I don't have any other income. So what I will wish to do, I will wish to govern by normal provisions. That means I want basic exemption limit. Okay, so I don't want this particular special rate of tax chapter. Better I will use the basic exemption limit, and in that case my tax liability is going to be nil. So if he wants to do like that, he can do that. So this is one of the reason, and this is one of the reason I'm telling you why non-resident Indian may elect or may prefer not to apply the provisions of this particular chapter, because your net tax liability in the normal provision may be lesser. So he would not like to pay a higher amount of taxes by the application of this chapter. Okay, so this can be a possibility, and this is what you'll have to give it in mind. Now this particular fact that the chapter by itself is optional, the students in the examination condition will have to do the tax liability 2 times. Okay, one, you will have to apply the special rate of this particular chapter and calculate the tax liability, and you will have to also calculate the tax liability by applying the normal provisions of the taxation and get the amount of the tax liability. You have to see which one is better, and then you have to take the decision. So this decision making process is going to be challenged in the examination condition. Okay, now friends, if you are governed by this particular chapter, chapter 12a, okay, now one of the thing is that investment income is something what is covered, specified investment income. Okay, and together with that, LTCG on the foreign exchange asset, LTCG on the foreign exchange asset. Okay, and foreign exchange asset is a specified asset, basically the shares, debenture, deposits, etc. So any gains on these financial assets like shares, specified assets, that is basically shares in Indian companies, debentures of companies other than private limited, basically public limited companies, debenture, deposits, or specified government securities. Okay, these are the major class of the assets, financial assets, which are covered. If these are subscribed into foreign currency, we'll call it as a foreign exchange asset. And this foreign exchange asset, if you have transferred, for example, there is a capital gains on the sale of the shares, then you can be covered by this particular chapter, and you'll have a special rate of tax in this particular chapter, as it has been clarified. Okay, now when there is any capital gains transaction, okay, now whether you will get indexation, whether you will get exchange rate fluctuation benefit, that is one of the another challenging area in this particular chapter. Okay, if you read the provisions of this particular chapter with respect to LTCG on the foreign exchange asset, it says that there will be a special rate of tax. Okay, however, Provision 1 to section 48, that means exchange rate fluctuation benefit will apply, but the Provision 2 to section 48 does not apply. That means indexation benefit is not applicable. And anyway, in relation to the shares debenture transaction, non-residents also not eligible for indexation, specifically as per the capital gains chapter. But this chapter reconfirms that. It says that you can take the benefit of Provision 1, that is exchange rate fluctuation benefit. However, you cannot take the benefit of the indexation. In other words, exchange rate fluctuation is just a substitute of the indexation. It's just a different method of giving a advantage for the investments into this particular investments of the non-resident into their specified assets. Now, one thing that you have to remember very clearly, that Provision 1, the exchange rate fluctuation benefit, it is irrespective of whether it is long term or short term. Okay, in other words, the non-resident shares debentures transactions, when you compute a capital gains, you will have to give exchange rate fluctuation benefit, and this is irrespective of whether it is a long-term transaction or a short-term transaction on the shares debenture. In other words, this is a definite benefit given to you by section 48, and from NRI point of view, read with chapter 12A provisions. So irrespective of whether it is long-term or short-term, you have to give the exchange rate fluctuation benefit. Now friends, one thing which I want to first of all bring it very clear to, how do you do the computation with respect to exchange rate fluctuation benefit? Now, exchange rate fluctuation benefit is, see, whatever the Indian rupee sale that you have already got. Okay, supposing you are selling shares and there is a capital gains on the sale of shares, and you should be non-resident Indian, because I'm talking about this particular chapter. Okay, and if you have to give the exchange rate fluctuation benefit, in that particular case, you have to convert the Indian rupee sale price into the foreign exchange by taking the appropriate buying selling TT rate and its average. Okay, so there is a methodology, friends, to convert, because in India, whenever you are going to sell the shares, the transaction in India is always going to be in the Indian rupees, no doubt about that. But that rupee sale price or full value of consideration has to be converted into the foreign currency by taking the appropriate exchange rate, buying selling rate, average as per the income tax rules. Okay, similarly, the cost also have to be converted in the foreign currency. The capital gains is to be computed in the foreign currency, and that computed in foreign currency has to be converted by the buying TT rate. We have to multiply with that particular buying TT rate and get the capital gains into the Indian rupees. Okay, so this is the method. Basically, the sale price you have to compute in foreign currency, cost you have to compute in foreign currency, capital gains you have to arrive in foreign currency, and the computed capital gains has to be converted into Indian rupees by taking the appropriate rate. And this method of computation in my regular class, so many times, friends, I have already explained, and I have solved a couple of questions also based on this. So you should know this particular method, because in the international taxation of the non-resident Indians, this particular point is always going to be very burning, the method in which the capital gains is to be computed. Okay, now against this, if you are making the reinvestment, then there is one special benefit under section 115F. This is something like your capital gains reinvestment. Like you have the capital gains exemption provision, section 54, 54F, etc. provisions. Similar type of provision is section 115F with respect to non-resident Indians. So when you make investment into the specified asset, which is again the shares debenture deposit, in that particular case, you will get the benefit of the exemption from the capital gains, and this is governed by chapter 12A. Okay, so you can reinvest your money and be eligible for the purpose of exemption. The amount to be reinvested, the optimum amount to be reinvested is a net consideration, Okay, so if you invest the entire net consideration back into the specified assets, you get full exemption. But if you do not reinvest the entire net consideration, and if you reinvest a lesser money, then you will get a proportionate benefit. So capital gains to be multiplied with the amount invested divided by the net consideration, that is a proportionate benefit. That much amount will be exempt under section 115F. However, if you wish, you are rich enough, you can make excessive investments also. That means if you invest more than net consideration, your entire capital gains will be eligible for the purpose of exemption under section 115F. Under this particular section, friends, there is no monetary limit. Like for example, it can be any X amount of the transaction, and subjected to the conditions, if you are reinvesting, you will be eligible for the purpose of exemption. So this benefit of the Proviso 1, this is what we got as a Proviso 1 benefit. This Proviso 1, the exchange rate fluctuation, is basically a substitute of their indexation benefit in the capital gains chapter with respect to the non-resident people, because for them the exchange fluctuation is more important than the inflation in the country, and that's the ideology of the law here. Okay. Now friends, when I say that Proviso 1 is applicable, it means that this is the method in which the computation is to be carried out. So if you are an assessee, listen very carefully. If you are an assessee, then this particular page, which I have also explained it to you in the regular class, this particular page and analysis should be very clear in your mind before you go for the exam. So if you are covered by chapter 12A, then there is a special rate of tax 10% with respect to the LTCG on the specified assets. So this entire analysis with respect to the LTCG onto the specified asset, got a special rate of tax, and instead you get Proviso 1 benefit, and Proviso 2 indexation benefit is anyway not applicable. So anyway, both the benefit though nobody gets in the world, like we get indexation and exchange rate, it is no way. Okay. So if one is applicable, the other is not applicable. And we are talking from with respect to the non-resident people. So non-resident people will always be inclined towards exchange rate fluctuation benefit. So naturally the indexation benefit will not be applicable. So that's a part of the analysis, and that is the part of the law also. Okay. So you have to remember that if somebody is covered by chapter 12A, and if you have this particular capital gains transaction, then such capital gains transaction is to be computed as per the Proviso 1 method, that means exchange rate fluctuation benefit method, and not as per your indexation method. Okay. So that is one of the points that should be kept very, very clear in your mind. Now this particular chapter 12A is optional. Okay. And since it is optional, you may also elect not to be governed by the provisions of chapter 12A. In that particular case, if this particular shares transactions, the specified asset, now I'm assuming the shares transaction, if the shares are the listed shares, and if they are traded into the recognized stock exchange, then you will be governed by 112A in the normal provision. Because in this particular chapter, you have to compute the tax liability both the times. You have to calculate the tax liability as per the provisions of chapter 12A and as per the provisions of normal provisions also. So if you are going by section 112A, then you will get a concessional tax rate which is 10%, and 112A is also going to give you a basic limit that your amount of capital gains up to a certain amount is not chargeable to tax at all. However, in this particular case, Proviso 1 and Proviso 2, both of them is not applicable. That means you have to sacrifice both of them. Indexation you don't get it, even exchange rate fluctuation you don't get it. If you are governed by section 112A, listed shares traded to recognized stock exchange, you get a concessional tax rate. Okay. So if you remember that if you are having a listed shares, and if you are doing a tax liability computation to the normal provision, then you have not to give indexation, and you have not to give exchange rate fluctuation benefit, and instead you have to give special tax rate of section 112A. This is one of the point, because you have to do calculation even in the normal provision tax liability. You also have to do the tax liability calculation as per the chapter 12. So you have to remember exactly whether exchange rate fluctuation in the typical situation is applicable or not applicable. That is going to be the key point in this particular situation. Okay. However, if it is not a listed shares, then we will divide the analysis into two parts, that whether it is a private limited company or it is a public limited company. If it is a private limited company, that is unlisted in the private limited company, then you will be governed by section 112. I repeat, because this entire analysis has been carried out only for the long term. So this analysis is only for the long term capital gains on the specified asset, the shares. Okay. So you will be governed by special tax rate. I repeat, you will be governed by special tax rate if the assess is a non-resident. Okay. And it's a private limited shares, and you will get a concessional tax rate that is 10%. However, you will have to sacrifice both the Proviso 1 as well as proviso 2, that means exchange rate fluctuation you will not get, and even proviso 2, that means indexation benefit you will not get it. Instead you will get a concessional tax rate. Now this is one of the very star and important provision, that the shares of the private limited company which has been transacted by the non-resident Indian is also covered by a special tax rate provision under section 112. And because these people normally miss this, I have already given the copy of that particular section 112, and in my regular class in detail I have explained this to you, but because this is a revision class I cannot do everything into the detail. So 112 1C provision subclause 3. See, if you go unlisted shares, this is a case of non-resident assessee, okay, then it will be taxable at the rate of 10%, you see, okay, without giving the effect to first and the second proviso of section 48. Okay, so this is a very special provision which gives you this particular benefit of 10% tax rate. Okay, however, if you are unlisted shares and if it is not a private limited company, that means if it is a public limited company, then you will be governed by 112 normal provision. 112 normal provision is a 20% tax rate. So if you see this particular provision, that normally any capital gains under section 112 is subjected to the normal tax rate of 20%. This is a 20% tax rate. See this. So under 112 for the non-resident, there is a special tax rate if it is a private limited company shares, and normally it is a 20% tax rate. Okay, so this will be the 20% tax rate. But if you are giving this 20% tax rate, then proviso 1 benefit, that means the exchange rate fluctuation benefit will be available to the taxpayer, and anyway you will take that particular benefit, but instead the tax rate will logically be on the higher side as per section 112. So you have to remember that if it is a unlisted shares, whether it is a shares of a private limited company or it is a shares of other than the private limited company, that is something you have to remember it very properly while arriving at that particular conclusion. Okay, so you have to give the answer both the ways, and however in examination condition they will ask you all the probability. So either they will say it's a private limited company or they will say it's a public limited company. So they will not ask you all the question in one particular, but you should know the matrix very properly, that in what situation you have to give proviso 1 and in what situation you have not to give proviso 1, and together with that what is the tax rate. So that combination of proviso 1 and the tax rate should be studied very properly. In my regular class friends I have explained this to you many times. However, being revision, I cannot do that everything into the detail, but whatever best which I can do for the revision, I'm just doing it. However, now supposing if you are listed shares, okay, but these listed shares, so for example I'm a non-resident Indian, I've invested into some listed shares of, say for example I've invested into the Reliance shares, which is listed and it is listed on the recognized stock exchange. Now I sell this particular share, but I'll sell it off market. That means I sell it to someone, but not a transaction done through recognized. I mean, I don't pay security transaction tax. Okay, and such kind of a transaction will not be governed by 112A. Okay, although it is a listed shares, but because I have not done the transaction through the recognized stock exchange, I will not be governed by 112, but I will be governed by normal provisions of 112, and there I am going to get 20% tax rate. This particular 20% tax rate, because I have not done the transaction through the recognized stock exchange. And don't forget, this is a complete analysis only for the long-term transactions. Okay, so long-term transaction of the specified asset for which only this particular analysis has been carried out. Okay, and if you are governed by this 20%, okay, in that particular case you are normally eligible for proviso 1, that is exchange rate fluctuation. You can take that particular benefit. Indexation benefit is anyway not available with respect to non-resident shares transaction. So accordingly, the computation is to be carried out. Now there is one very important point here, that if you are governed by this particular section 112, then under section 112 for the listed shares without the indexation, the tax rate is 10%. So you can take up that particular advantage, that without taking the benefit of the indexation, you can take a tax rate of 10% with respect to the listed shares. So that particular option, which is normally given by the provisions of section 112, this can be taken. But this is now a little bit debatable. That debate I have already told you in our regular class, but I'll not like to repeat that here. Okay, so here what is 20%? This could be 10%, but without taking the benefit of the indexation. But now where the confusion and complication which is going to arise, okay, that you understand. The complication will arise that when I am saying that I am not eligible and I am not going to take the indexation, I am anyway not eligible for indexation. So somebody will interpret like that because I am a non-resident, I am anyway for the shares transaction, I am not going to get the benefit of the indexation. So instead of this 20% tax rate, straight away I will take a 10% tax rate. So straight away I am going to get the benefit benefit in terms of the tax cuts, and accordingly I'm going to apply this particular provision. And this is debatable. Reason being that the intention of the law that without indexation you get a 10%, that means you have to sacrifice the indexation, but exchange rate fluctuation is a substitute of that. So another school of thought will say that you have to sacrifice provision 1 also. That means if you sacrifice provision 1, that means exchange rate fluctuation, then you take a concessional tax rate for the listed shares transaction done off market. So that school of thought do prevail, but as I told you, this is a debatable point. And this particular point, friends, whenever the question comes, and the situation of the question will be like that, okay, the shares which have been transacted is a listed share. That will be the situation which will be given to you in the examination condition, but the transaction which is done is a off market. This is a off market transaction of the listed shares, and this situation is a typical situation with respect to the non-resident, and accordingly this can be a very hot question in the examination condition to be answered. And this type of question you have to take care of it. Now friends, if somebody elect to go by chapter 12a, listen very carefully. So there also you will have the shares transaction, no, but under chapter 12a, friends, all the types of situations are covered. Okay, so you will say for example listed, you will say not listed, you will say private limited, you will say public limited, all the variation, whatever that you want to say, everything is covered by only one specific provisions of chapter 12a. So under chapter 12a there is no variations like what is difference if it's a private limited share, public limited share, listed share, not listed share. There the computation is one standard format of computation, so there you don't have the variation. But because the chapter is optional, you have to do the tax liability calculation as per the normal provision. You have to do as per the normal provision, and in the normal provision you will have all these variation. So depending upon the facts which is printed before you in the examination condition, accordingly you will have to answer this particular question. Now friends, this analysis of this provision 1, provision 2 with respect to non-resident and long-term capital gains on the sale of shares, these analysis you should remember it very properly in the examination condition. And this is one page which I had also given it to in our regular class. However, I'm not repeating that, but this is just the verbatim of the same analysis, but it is given to you in the tabular format. Okay, so this particular page also should be studied very properly by you in the before you go for the examination condition very properly. In what situation you have to give provision 1, in what situation you might have to give the indexation. But however, non-resident is not eligible for indexation for shares transaction. However, if he was a resident person, then this was a separate analysis, and this should be done very properly, studied very properly by the student before you go for the examination. And then friends, in my regular class I had already given you some of the examples like that, some few questions which I had already solved like that by giving you all the probabilities and the situation, and those questions, friends, you should remember it very properly. And I'm not taking it out here because that's just the repetition of the same thing which I already explained that to you some time back, but I just showed this particular page that we already explained and computed the variety of the situation, and you should do it by yourself very properly. Now friends, this is one particular page which I had already given it to in my regular class, where I have given you the difference from the tax liability and the computation point of view. However, there are many differences between resident type assessee and the non-resident type assessee. Now, it is just non-resident. Earlier, everything that we discussed was non-resident Indians. Now it is general purpose, non-resident. Okay. So, resident and non-resident tax liability differences. That what are the differences here? Okay. Now, for example, under these three section, 111A, 112 and 112A, basically your short-term transactions of listed shares, long-term capital gains of any type of the assets, and 112A, that is basically the long-term capital gains of the listed shares subjected to the STT. Okay. Now, all the three sections, a resident person can use the basic exemption limit. Okay. So, and a non-resident person cannot use the basic exemption limit. Okay. So for some of the specified type incomes, the resident persons are given the benefit to utilize a basic exemption limit towards that particular type of income in the tax liability calculation, but the non-residents cannot use that particular advantage. Now any other incomes, okay, but governed by the special rate chapter provision. Okay, the basic exemption even resident person cannot use it. Okay, non-resident anyway cannot use it. Now I'll give you one very simple example. For example, there is a casual income. Okay, the horse races income, section 115 BB incomes, or any other incomes governed by chapter 12. Okay, so if a resident person is subjected to the taxation, he will not get a basic exemption limit. For example, casual incomes, on that there is a special rate of tax, so that income multiplied with the special rate of tax, you cannot get a basic exemption limit. Okay, so that is a standard theme in your special rate chapter, where normally the basic exemption is not available against the specified incomes. However, in certain places there are relaxation which is already been provided. Another thing is that if you are a senior citizen, then resident senior citizen get a higher basic exemption limit, but a non-resident senior citizen does not get a higher basic exemption limit. Rebate of section 87A on merits is available to a resident person, but a non-resident person is not at all available, because the rebate of section 87 is only for the resident individual. 80D senior citizen, that is a Mediclaim, you have a higher limit if you are a resident senior citizen, and if you are a non-resident senior citizen, you get a normal limit. That means you do not get the benefit of the higher limits under that particular section. The very simple example, supposing there is a long-term capital gains of only 10,000 rupees, so resident person will say that my tax liability is nil because I am going to use the basic exemption limit. But a non-resident person cannot say that, because non-resident person cannot use the basic exemption limit. So non-resident person will be liable for the purpose of taxation. So on 10,000 rupees, 20% you will have to pay tax on that particular front. Okay. Now there are some differences with respect to provision 1 and provision 2. See, if there is any transaction of section 112A, resident also there is no provision 2 benefit whatsoever. Even the non-resident don't get provision, because 112A, that is a listed shares transaction, is not eligible for any indexation, is not eligible for any exchange rate fluctuation benefit in either of the situation, whether you are resident or non-resident whatsoever. Okay, so that you got to remember very precisely. Now, long-term capital gains on unlisted shares, but if it is a private limited company, okay, now if you are a resident person, then you will get a normal indexation. So if a resident person sells the private limited shares, and normal indexation computation is applicable. But for non-resident person, there is no provision 1 and no provision 2. Now, some time back also I explained this particular point. That means a non-resident person don't get any exchange rate fluctuation or indexation benefit with respect to the transaction of shares into the private limited company. Instead, you are eligible for a special tax rates as per section 112 provisions. Okay. Further, if there is any unlisted shares, but if it is of a public limited company, then normal indexation is available, okay, to the resident person, but the non-resident person cannot get indexation benefit, but he will get exchange rate fluctuation benefit. So basically, exchange rate fluctuation means the provision 1 benefit, indexation means the provision 2 benefit. Accordingly, you have to do that particular computation, that what provisions applicable to non-resident and what provisions applicable to resident. So this different. However, there are many differences, friends, but all the differences I cannot do it in the revision class. But this is the most popular differences. I repeat, these are the most popular differences between resident and non-resident computations, which in the revision class I just thought that I should bring it to your notice, and so that because these are more popular from examination point of view, you better remember and study before the examination.